Good evening and a warm welcome to everyone for this webinar. My name is Saju from HDFC Securities. This is an exclusive webinar for an ICICI Pru Business Cycle Fund, which will open up tomorrow, and that is 29th of December, and this fund will close on 12th of January 2021. So probably this would be the last NFO that will be coming up this year. And to help us with the details of this NFO, we have Mr. Anish Talwalke, Fund Manager and Head Research, ICICI Prudential Asset Management Company Limited. So a warm welcome to you, Anish. Over to you. So if you can help us, we can start probably 5 minutes on the market, the current market scenario, and then you can cover up the fund details as well.
Yeah. Thank you very much, Saju. I will, if it's okay with you, I'll just talk a little bit about the fund and then put the market in that context, because to explain why this
is
appropriate at this point in time.
Right.
So look, basically, we all know that the economy goes through cycles, right? You have economic booms and you have slumps. What does a boom look like? A boom, basically, there is very strong demand. So factories are operating at full capacity, 3 shifts. In fact, they're adding capacity. So investment is strong, credit growth is strong. Obviously, when there is a strong demand, there is strong growth in employment also. People have multiple job offers, get big wage increases. On the other hand, in a slump, you have, basically there is a shortage of demand. So people are focusing on cutting costs. Nobody's investing, and employees are barely happy to keep on to existing jobs rather than expecting salary increases. Now, obviously, depending on where the economy is, different sectors do well, right? In a boom, you would see strong demand with investment activity. You would see strong demand for capital goods. You would see strong credit growth. So banks would also do well. There would be low NPAs because the economy overall is doing well. Whereas in a slump, those would be sectors you would want to avoid. So basically, that's what this fund is about, right? At any point in time, we will be focusing on a few sectors, and the bulk of the investments of this fund will be within a few sectors, right? So if we think the economy is bottoming out and picking up, we will focus on sectors like capital goods, banks, etc. Whereas if we feel, look, the economy is stalling, then we would shift focus to more conservative sectors like FMCG or pharma, more importantly. Right? So that's the idea behind this fund. Now, and to do this, we will be looking at both the where the domestic cycle is and where the global cycle is, right? So if we feel the global economy is stronger than the Indian economy, then we skew the portfolio towards sectors that benefit from a strong global economy. So that is the idea. It's actually very simple. So investors can think of this fund as a fund, where at any point in time it will look like a thematic, but the themes will keep changing over time. Right, so it's not, the theme doesn't remain constant. The theme changes, the sector allocations change based on what is appropriate at that time. But there are big concentrations, right? So it's not going to be, you will not find this fund having all sectors roughly in line with the index. You will find at different points in time, different sectors are pretty important. Now, why we thought this fund is appropriate at this point in time, and then in that context, I'll also address, Saju, your question about what is the market outlook. So, actually, if you look even at 2020, right, this year has been a year of macro investing, right? Basically, what the markets held up because there was very strong, globally and in India, policy support. So monetary policy was very easy. There was a lot of fiscal spending, at least globally, and that's why the economies held up, and also consequently the markets held up. In March or April, if anybody had been doing bottom-up analysis only, you would not have made the right decisions. So macro is very, very important, particularly when there is so much uncertainty about how macro will evolve, right? And I think that our view is that that situation persists for the next 3-4 years at least, right? So if you look at where interest rates are so low, both globally and in India, fiscal deficits are large. And that's a good thing, but that's a good thing at this point. But they will not always remain this large. So how these variables change will have a very big impact on the economy, and the economy can take different paths. So you can't, at this point, you can't really have very confident macro forecasts for the next 4 years. If you can be so just to contrast it with the situation, right, from 2000, say, particularly globally, right, from 2012 to 2018, it was relatively, or 2013 to 2018, it was relatively stable, right? Basically, macroeconomic environment was very stable, financial sector had recovered. That was really a good time for bottom-up investing. Now what we feel is that it's an important, it's a good time for looking at things top down in addition to bottom up. But here the fund will be focused on top down investing. Now, as I said, right, so the path that the markets will take and the path that the economy will take, at this point there is a fair amount of uncertainty. When will the Federal Reserve tighten? In the start tightening if the U.S. economy recovers sooner, will have a big bearing on the market. Similarly, will the RBI start focusing on getting inflation down to 4%, or will it remain relatively relaxed about inflation being higher than 4%, even higher than 5% for an extended period of time, as long as it remains below 6? Those things will matter for the markets. So where are we now? What is our current view? Look, we firstly, on the economy, we do think that the economy has bottomed out, right? So and what has helped a lot, two things have really helped. One is interest rates have been very, very loose. So if you look at 1-year GSEC yield, 3-year GSEC yields, 5-year GSEC yields, we are at 2003 levels, right? So interest rates are very, very low, and across the yield curve, their policy looks accommodative, supportive. Second, and this is very, very important, what has happened is real estate prices have started correcting, right? So a real estate price correction is really healthy for the economy, because ultimately real estate cycle, firstly inventory will get cleared, and then hopefully home building activity, construction activity will restart. And construction activity is phenomenally good for the economy, because it creates employment, it creates steel demand, it creates cement demand. And once you have houses, people also buy manufactured goods to put in those houses, right? Nobody lives in an empty house, so you buy manufacturing. Then second order stimulus is for manufacturing. So that's, I think, where we are. It's quite possible that the economy builds momentum, particularly if interest rate policy remains light, easy, and things pick up, so the economy strengthens. Having said that, multiples are rich, right? So nobody would argue that the market is not anticipating it. So the multiples are already pricing in some of the recovery. So in that context, our view is that one cannot play for multiple expansion. Right? One has to look for, if one is investing at this point in time, one has to look for sectors where earnings could surprise on the upside. Right? It's not a multiple expansion, but an earnings growth surprise that one has to look out for. So where are earnings? If you look at a 5, 10, 15 year, 10 or at least 12-year period, which are the sectors where earnings have disappointed, right? I mean, if you go back, so you would find that sectors like capital goods, sectors like deposit-rich corporate banks, they have actually not delivered, and some of the infra and real estate sectors again have not delivered for the last 5 or 10 years. So if the economy were to pick up, these would be sectors where you could see earnings surprises, and that's where I think at this point in time it looks like the one needs to focus on. But again, as I said, whether these surprises actually come through, whether the economy builds momentum, will depend on whether monetary policy remains easy, whether fiscal policy remains supportive. All these things will have to be watched going forward. We're not entering a market with super cheap valuations. So I'll stop there and take questions.
Sure. Thank you, Anish. So participants, we are open for any questions. You can just click on the question mark sign that you see right on the top and ask your questions. So Anish, one of the participants would like to know which sector as of now looks very attractive. Uh,
No, so as I was mentioning, the sectors where we could potentially see earnings surprises would be sectors like capital goods. It would be, some of the deposit-rich corporate banks. It could be some of the infrastructure sectors, including telecom. The sectors, actually, more importantly, the sectors where I would stick my neck out and say, the sectors that should be avoided. One would be retail lenders, particularly retail lenders without deposit franchises, right? So NBFC retail, pure retail NBFCs would still be, something to avoid, because we think there is likely to be some credit stress which the market is not pricing in right now. Second, I think FMCG is another one that has to be avoided. FMCG, our view is that it's not just that the multiples are rich, actually their margins are also at historical peaks. So a lot of FMCG companies are at 20-year peak margins, and margins should revert to the mean. So when margins correct, then you will see, then we think that they are likely to disappoint on earnings. So you'll get both multiple margin compression and multiple compression, because once earnings disappoints, we also don't think then the multiples will sustain this high. So the sectors that we are very comfortable avoiding at this point would be FMCG and retail heavy lending.
Okay. Thank you. The next question is from Raju Gopalan. So he would like to know that by shifting focus from one sector to another, there will be increased expenses on buy and sell of the investment. How do you think the investment expense will be controlled in this case? So
look, hopefully we'll be shifting sectors after they have delivered for us. So the returns should cover the expenses. And the point is that, look, that is a part of active fund management, right? Normally, even if you do bottom-up stock picking, when you shift from one stock to another, you incur expenses. The point is that, look, we do not expect churn in this fund to be very high, right? We will churn when we see macroeconomic conditions changing. Now, if really they are changing very quickly, then yes, there could be high churn, but then it makes sense to churn, right? But we would not be churning just for the sake of churning. So I would expect that these, this macroeconomic cycles take like a good 3-4 years to play out, right? So if things evolve as if the fund is appropriately positioned, then it's not going to be a high churn fund.
Okay. The next question is from Ashish. He would like to know, which index would be the benchmark for this fund?
It's NSE 500. But this is not going to be an index hugging fund, as I mentioned. While that is the index we'll be measured against, at any point in time, we will have significant deviations in the portfolio from the index, right? So this is a fund which will, and hopefully those, obviously our intent will be that to create alpha from those positions, but it's not going to be something that mirrors the index very closely, right? The fund. So you might find that some sector is relatively large in the index, but we don't like it at that point in time, and we have a zero weight in that sector.
Okay, Anish. The next question is from Sunil. So he would like to know that is this the right time to make the investment, or should he hold on for some corrections and probably then make the investment?
So look, what we are saying to our investors and to retail investors is that our view is that asset allocation products are the best products at this point in time. So something like a BAF or AF, we are not saying take money out of a BAF, a balanced advantage fund, or an asset advantage allocation fund and put money in this fund. But if you have an allocation to equities and if you have equity funds, then within that segment, this is a good fund. This is a very good, I mean, we think it's a very good fund for equity investment from your equity portfolio.
Okay. I think the next question, will it be ELSS? No, Ashish, this is not an ELSS fund. So the next question is from Sandeep. The question is, there are of late been many NFOs that has been launched. So how is this fund going to be different from those?
So, to be honest, I can't really talk about all the other NFOs and how they are positioned. I can talk about this. Look, the way to think about it is that, again, that see, you invest in sector funds, right? But sometimes you say, oh, this right now the banking sector fund looks attractive, or you say now the FMCG fund looks attractive, or now the pharma's funds looks attractive. This fund will take that hassle out of the investors, take that hassle off the investors' plate. We will select the sectors that we think are appropriate. So what you will find, right? If Naren is saying, look, I think it's time to invest in banking and infrastructure fund. You will find that if that is the case, then this fund will also have a lot of exposure to banking and infrastructure, right? If Naren is saying, look, at this point, invest in FMCG and pharma, you will find that this fund also has a lot of investment in this. So what I would say, about this fund is, this fund will have significant sector skews. So it will have strong, you'll find that there's very high sector concentration, and you will find that this sector concentration is justified by a top-down approach, right? And we think that at this point in the cycle, given where macroeconomic conditions are, top-down investing will make sense rather than just bottom-up stock picking. Also, we'll look at bottom-up stock picking, but that will be done after we've selected sectors top-down.
Sure, Anish. The next question is, will gold be a part of the investment in this fund? No.
No, gold is not part of it.
So we have one of the participants asking, any particular sector that you'll be targeting for the next 3 to 5 years in this fund?
So actually, that is another. I'm very glad that you asked this question. See, if you target a sector for 5 years, what you are really saying is, look, I believe in that sector structurally, right? As opposed to what we are saying here, we will be looking for cyclical opportunities. See, one can take the view that there is a sector that over 20 years it will grow, and I'm going to invest for 20 years and put all my money in that sector. That is not what this fund will be doing. Even if we believe that, look, the sector goes for 20 years, will do well over 20 years, we believe that the sector has ups and downs, right? So we will trade in and out of those ups and downs. So when, so this fund will not have sectors that remain constant. Unlikely that the sectors will remain constant for 5 years. Now, if it so happens that we get a very, very sustained, strong recovery with absolutely no problems, current account deficit remains stable, inflation remains stable, and investment activity remains strong, then it could happen. It's unlikely, but it could happen that you remain invested heavily in banking or capital goods for a long period of time. But cycles typically don't last 5-7 years at one go. The reason we are launching this fund at this time is because we think we will have opportunities to to change sectors and make money by changing sectors over time appropriately.
Okay, Anish. So the next question we have is from Sushant. So he would like to know that will there be any restrictions in terms of which sectors to invest at at any point of time, whether you'll be investing only in 3 sector at a point, is there any such limitation, or you'll be
So
open
there
to?
isn't a limitation, but I can give you some guidance. Over at any point, we would expect the large part of the funds portfolio, a large part, right, to be in 2 to 5 sectors. Now, I don't want to put a restriction of 5, because that would might force me to get out of some few stocks that I hold. So, for example, right, say we invest in one sector, right, say banking, and five of the 6 stocks we bought in banking did well, but one is taking a little bit more time to play out. Now, I don't want to be forced to sell, because the number of sectors will go up to 6 if I don't sell. So what I'm saying very clearly is that yes, it will have high sector concentrations. 2 to 5 sectors will account for the bulk of the investment, bulk predominant, but there might be some tail left over from sectors that we are in the process of exiting.
Sure, Anish. So, Sajid would like to know what is the expense ratio of this fund going to be? Um,
Okay, I actually don't know that. I'm on the investment side, so I'll ask us if somebody is there from our sales team to
so
help me out.
Rohit
Yeah,
is there.
yeah. So on the expense side, basically it will also be running on the similar fund as per the SEBI guidelines. So to start off with, of the size, if we look out at, I think if the fund goes in the range of somewhere close to say above 2000 odd crores, that is what that we are targeting at the NFO collection, then the expense should remain in the range of somewhere close to 1.6 to 1.7.
Sure.
But
Thank
subject to
you.
the fund achieving that size. So it's basically will be
Yeah,
determined
yeah.
by.
But it will be definitely determined by the size of the fund to start off with.
Okay. Thank you, Rohit. The next question is from Vishal. He would like to know what kind of returns can be expected from this fund in next probably 1 or 2 years.
It's a good thing that we are not allowed to promise returns and give target for expected returns. It would not be in my interests or the interests of investors to be promised
Right.
returns and then be disappointed. It doesn't make sense.
Right. Uh, then the next question is from Kashyap. He would like to know that whether this fund will invest in global equities.
Yes, we have an allocation. We can go up to 15% in global equities, in non-India equities.
Okay, and it will not be only focused to the US market, right? So it will be global.
Yeah, so see, typically what we do for that is that we would take like ADRs,
Mhm.
listed in the US,
Right.
because a lot of the large companies have ADRs, and we don't want to. I mean, typically we would not be investing in some small company which is a UK only company or something like that, right? Listed only in the London Stock Exchange. So typically what ends up happening is we take ADR positions. So for example, if you look at the MNC fund, which I also run, right? We own AB InBev, which is predominantly a European company, but we bought the ADR. Similarly, we own Diageo, the parent of United Spirits, but it's a UK company, but we own the ADR. So typically we prefer, because it's more liquid, like it's better regulated. I mean, it's a very well regulated market, so we typically end up on New York.
Okay. Thank you, Anish. So we'll pick the last question for the day, which is if it's since this fund is will be investing in the global equities as well, will there be any change in the capital gain tax?
No. So it will qualify as an equity fund, because the amount of global equity investment is not so large as to change the equity classification of this.
Okay. All right, Anish. So that's it. Thank you so much for taking out your time from your busy schedule and helping and sharing out the details of this fund and what opportunity the investors has got with this fund. Yeah. Once again, thank you, Anish. Thank you, Rohit. Dear participants, this fund will open tomorrow, which is 29th of December 2020, and it will be available on the HDFC Securities platform as well. You can just log in and make your investments. And this fund will close on 12th January 2021. In case you have any queries, you can reach out to your relationship manager to help you out with your queries. So any last thought, Anish, before we conclude this webinar?
I think, Saju, we've covered almost all the aspects very comprehensively. As I said, we do think this is a good fund for the current environment, for the equity allocation in this current environment, and we welcome your participation. Also wish all of you a very happy and prosperous 2021. Hopefully it's a much better year from a social perspective than 2020 has turned out to be. Thank you very much.
Right. Yeah. Thank you, Anish. Thank you, Rohit, once again.
Thank you, Chaju. Thank you so much for giving us the opportunity. Thanks. Thank you, everyone.